Today, we're diving into the exciting world of futures and options trading. By the end of this video, you'll have a solid grasp of these powerful financial tools and how they can help you manage risk and seize opportunities. Whether you're a complete beginner or just looking to brush up on the basics, this video is for you. Let's get started. This content is for educational purposes only and does not constitute financial advice. Please consult a licensed professional for specific investment guidance. Imagine being able to lock in a price for an asset today and buy it in the future. Sounds interesting, right? Futures are contracts where you agree to buy or sell an asset at a predetermined price on a specific future date. They're commonly used in commodities trading. For example, a coffee producer might use futures to lock in prices and protect against market fluctuations. Let's say a coffee farmer expects the price of coffee to drop in the next 6 months. By entering into a futures contract, they can lock in the current price and avoid potential losses. Have you ever thought about how businesses manage price risks? Let us know in the comments. Now, what if you had the right but not the obligation to buy or sell an asset? That's where options come in. Options are contracts that give you the right but not the obligation to buy, call option, or sell, put option, an asset at a set price before a certain date. This flexibility makes options a popular tool for both hedging and speculation. Imagine you think the stock price of a company will rise. You can buy a call option, giving you the right to purchase the stock at today's price, even if the price goes up in the future. Which do you think is more flexible, futures or options? Share your thoughts below. Think you know the difference between futures and options? Let's break it down. While both are derivatives, the key difference lies in the obligation. Futures contracts require the transaction to occur, whereas options give you the choice. This fundamental difference impacts how each is used in trading strategies. Consider a company that needs to buy oil. With a futures contract, they must buy the oil at the agreed price on the future date. With an option, they can choose to buy the oil if the market price is favorable. Did you find this comparison helpful? Give us a thumbs up if you did. You won't believe how these trading tools can protect your investments from market volatility. Curious about how futures and options are used in real life? Let's explore some practical examples. Futures and options are used by various market participants, including farmers, manufacturers, and investors, to hedge against risks and speculate on price movements. A farmer might use futures to lock in the price of their crops, ensuring they get a fair price regardless of market fluctuations. An investor might use options to speculate on stock price movements, potentially earning profits without committing to buying the stock outright. Can you think of other ways futures and options might be used? Share your ideas in the comments. Did you know you can also sell futures and options? Let's see how it works. Selling futures and options can be a strategy to generate income or hedge against potential losses. When you sell a futures contract, you're agreeing to deliver the asset at a future date. When you sell an option, you're giving the buyer the right to buy or sell the asset at a set price. Imagine you own shares of a company and you sell a call option. If the stock price rises above the strike price, the buyer may exercise the option, and you'll sell your shares at the agreed price. If the price doesn't rise, you keep the premium from selling the option. Have you ever considered selling futures or options? What strategies would you use? Let us know in the comments. Every investment comes with risks and rewards. Let's see what you need to know about futures and options. While futures and options can offer significant rewards, they also come with risks. It's important to understand these risks before diving in. With futures, you could face significant losses if the market moves against your position. Selling options, especially, can be risky. For example, if you sell a call option and the stock price skyrockets, you could face unlimited losses as you are obligated to sell the stock at the strike price, even if the market price is much higher. Have you ever taken a risk that paid off? Tell us your story in the comments. To recap, futures are contracts with an obligation to buy or sell at a future date, while options give you the right but not the obligation. Both can be powerful tools in managing financial risk. And remember, you can also sell these contracts to generate income or hedge against losses, but be aware of the significant risks involved. This is just the tip of the iceberg when it comes to futures and options trading. There's so much more to explore. If you want us to dive deeper into these topics, show us some encouragement by liking and subscribing. It helps us reach more people and lets us know that you enjoy this content and want more like it. We're putting a lot of effort into bringing you the best content, and your support means the world to us.